organism about 400 years ago. Errors of nature, sports, and monsters correct the understanding in regard to ordinary things, and reveal general forms. For whoever knows the ways of nature will more easily notice her deviations, and, on the other hand, whoever knows her deviations will more accurately describe her ways. We document in this section the evidences showing that large market drops are outliers and that they reveal fundamental properties of the stock market. What are abnormal returns? Stock markets can exhibit very large motions, such as rallies and crashes. Should we expect these extreme variations? Or should we consider them as anomalous? Figure 2 shows the distribution of daily returns of the DJIA and of the Nasdaq index for the period January 2, 1990 till September 29, 2000. For instance, we read on the figure 2 that 5 negative and 5 positive daily DJIA market returns larger or equal to 4% have occurred. In comparison, 15 negative and 20 positive returns larger or equal to 4% have occurred for the Nasdaq index. The larger fluctuations of returns of the Nasdaq compared to the DJIA are also quantified by the so-called volatility, standard deviation of returns, equal to 1.6%, respectively 1.4%, for positive, respectively negative, returns of the DJIA, and equal to 2.5%, respectively 2%, for positive, respectively negative, returns of the Nasdaq index. The lines shown in Figure 2 correspond to represent the data by an exponential function. The upward convexity of the trajectories defined by the symbols for the Nasdaq qualifies a stretched exponential model which embodies the fact that the tail of the distribution is fatter, i.e., there are larger risks of large drops, as well as UPS, in the Nasdaq compared to the DJIA. Let us use the exponential model and calculate the probability to observe a return amplitude larger than, say, 10 standard deviations, 10% in our example. The result is 0.000045, which corresponds to 14-1 event in 26 days, or in 88 years. The drop of 22.6% of October 19, 1987 would correspond to one event in 520 million years, which qualifies it as an outlier. Thus, according to the exponential model, a 10% return amplitude does not qualify as an outlier, in a clear-cut and indisputable manner. In addition, the discrimination between normal and abnormal returns depends on our choice for the frequency distribution. Qualifying what is the correct description of the frequency distribution, especially for large positive and negative returns, is a delicate problem that is still a hot domain for research. Due to the lack of certainty on the best choice for the frequency distribution, this approach does not seem the most adequate for characterizing anomalous events. We now introduce another diagnostic that allows us to characterize abnormal market phases in a much more precise and non-parametric way, i.e., without referring to a specific mathematical representation of the frequency distribution. Drawdowns, runs. Extreme value theory, EVT, provides an alternative approach, still based on the distribution of returns estimated at a fixed time scale. Its most practical implementation is based on the so-called peak-over-threshold distributions, which is founded on a limit theorem known as the Denko-Pickens-Balkemata-Hahn theorem, which gives a natural limit law for peak-over-threshold values in the form of the generalized Pareto distribution, GPD, a family of distributions with two parameters based on the Gumbel, Weibull, and Fréchet extreme value distributions. The GPD is either an exponential or has a power law tail. Peak over threshold distributions put the emphasis on the characterization of the tails of distribution of returns and have thus been scrutinized for their potential for risk assessment and management of large and extreme events. In particular, extreme value theory provides a general foundation for the estimation of the value at risk for very low probability extreme events. There are, however, severe pitfalls in the use of extreme value distributions for risk management because of its reliance on the unstable estimation of tail probabilities. In addition, the EVT literature assumes independent returns, which implies that the degree of fatness in the tails decreases as the holding horizon lengthens, for the values of the exponents found empirically. Here, we show that this is not the case. Returns exhibit strong correlations at special times precisely characterized by the occurrence of extreme events, the regime that EVT aims to describe. This suggests to re-examine EVT and extend it to variable time scales, for instance by analyzing the EVT of the distribution of drawdowns and draw-ups. A drawdown is defined as a persistent decrease in the price over consecutive days. A drawdown is thus the cumulative loss from the last maximum to the next minimum of the price. Drawdowns embody a rather subtle dependence since they are constructed from runs of the same sign variations. Their distribution thus captures the way successive drops can influence each other and construct in this way a persistent process. This persistence is not measured by the distribution of returns because, by its very definition, it forgets about the relative positions of the returns as they unravel themselves as a function of time by only counting their frequency. This is not detected either by the two-point correlation function, which measures an average linear dependence over the whole time series, while the dependence may only appear at special times, for instance for very large runs, a feature that will be washed out by the global averaging procedure. To demonstrate the information contained in drawdowns and contrast it with the fixed timescale returns, let us consider the hypothetical situation of a crash of 30% occurring over 3 days with 3 successive losses of exactly 10%. The crash is thus defined as the total loss or drawdown of 30%. Rather than looking at drawdowns, let us now follow the common approach and examine the daily data, in particular the daily distribution of returns. The 30% drawdown is now seen as 3 daily losses of 10%. The essential point to realize is that the construction of the distribution of returns amounts to count the number of days over which a given return has been observed. The crash will thus contribute 3 days of 10% loss, without the information that the 3 losses occurred sequentially. To see what this loss of information entails, we consider a market in which a 10% daily loss occurs typically once every 4 years. This is not an 15 unreasonable number for the Nasdaq Composite Index at present times of high volatility. Counting approximately 250 trading days per year, 4 years correspond to 1,000 trading days and 1 event in 1000 days thus corresponds to a probability 1/1,000 equals 0.001 for a daily loss of 10%. The crash of 30% has been dissected as 3 events which are not very remarkable, each with a relatively short average recurrence time of 4 years. The plot thickens when we ask what is, according to this description, the probability for 3 successive daily losses of 10%. Elementary probability tells us that it is the probability of one daily loss of 10% times the probability of one daily loss of 10% times the probability of one daily loss of 10%, giving 10/9. This corresponds to a 1 event in 1 billion trading days. We should thus wait typically 4 million years to witness such an event. What has gone wrong? Simply, looking at daily returns and at their distributions has destroyed the information that the daily returns may be correlated, at special times. This crash is like a mammoth which has been dissected in pieces without memory of the connection between the parts, and we are left with what look as mouses, bear with the slight exaggeration. Our estimation that 3 successive losses of 10% are utterly impossible relied on the incorrect hypothesis that these 3 events are independent. Independence between successive returns is remarkably well verified most of the time. However, it may be that large drops may not be independent. In other words, there may be burst of dependence, i.e., pockets of predictability. It is clear that drawdowns will keep precisely the information relevant to identify the possible burst of local dependence leading to possibly extraordinary large cumulative losses. Our emphasis on drawdowns is thus motivated by 2 considerations. 1. Drawdowns are important measures of risks used by practitioners because they represent their cumulative loss since the last estimation of their wealth. It is indeed a common psychological trait of people to estimate a loss by comparison with the latest maximum wealth. 2. Drawdowns automatically capture an important part of the time dependence of price returns, similarly to the run statistics often used in statistical testing and econometrics. As previously showed, the distribution of drawdowns contains an information which is quite different from the distribution of returns over a fixed time scale. In particular, a drawdown embodies the interplay between a series of losses and hence measures a memory of the market. Drawdowns exemplify the effect of correlations in price variations when they appear, which must be taken into account for a correct characterization of market price variations. They are direct measures of a possible amplification or flight of fear where previous losses lead to further selling, strengthening the downward trend, occasionally ending in a crash. We stress that drawdowns, by the elastic time scale used to define them, are effectively function of several higher-order correlations at the same time. Johansson and Sornet have shown that the distribution of drawdowns for independent price increments x is asymptotically and exponential, while the body of the distribution is Gaussian, when the distribution of x does not decay more slowly than an exponential, i.e., belong to the class of exponential or super-exponential distributions. In contrast, for sub-exponentials, such as stable Levi laws, power laws, and stretched exponentials, the tail of the distribution of drawdowns is asymptotically the same as the distribution of the individual price variations. Since stretched exponentials have been found to offer an accurate quantification of price variations, thus capturing a possible sub-exponential behavior, and since they contain the exponential law as a special case, the stretched exponential law is a good null hypothesis. Johansson and Sornet have analyzed the major financial indices, the major currencies, gold, the 20 largest U.S. companies in terms of capitalization, as well as 9 others chosen randomly. They find that approximately 98% of the distributions of drawdowns is well represented by an exponential or a stretched exponential, while the largest to the few 10 largest drawdowns are occurring with a significantly larger rate than predicted by the exponential. This is confirmed by extensive testing on surrogate data. Very large drawdowns thus belong to a different class of their own and call for a specific amplification mechanism. Draw-ups, gain from the last local minimum to the next local maximum, exhibit a similar behavior in only about half the markets examined. We now present some of the most significant results. Testing outliers. Testing for outliers, or more generally for a change of population in a distribution, is a subtle problem. The evidence for outliers and extreme events does not require and is not even synonymous in general with the existence of a break in the distribution of the drawdowns. Let us illustrate this pictorially by borrowing from another domain of active scientific investigation, namely the search for the understanding of the complexity of eddies and vortices in turbulent hydrodynamic flows, such as in mountain rivers or in the weather. Since solving the exact equations of these flows does not provide much insight as the results are forbidding, a useful line of attack has been to simplify the problem by studying simple toy models, such as shell models of turbulence, that are believed to capture the essential ingredient of these flows, while being amenable to analysis. Such shell models replace the three-dimensional spatial domain by a series of uniform onion-like spherical layers with radii increasing as a geometrical series 1, 2, 4, 8, 2n and communicating with each other typically with nearest and next nearest neighbors. As for financial returns, a quantity of great interest is the distribution of velocity variations between two instants at the same position or between 2 points simultaneously. Such a distribution for the square of the velocity variations has been calculated and exhibits an approximate exponential drop-off as well as a coexistence with larger fluctuations, quite reminiscent of our findings in finance. Usually, such large fluctuations are not considered to be statistically significant and do not provide any specific insight. Here, it turns out that it can be shown that these large fluctuations of the fluid velocity correspond to intensive peaks propagating coherently over several shell layers with a characteristic bell-like shape, approximately independent of their amplitude and duration, up to a rescaling of their size and duration. When extending these observations to very long times so that the anomalous fluctuations can be sampled much better, one gets a continuous distribution. Naively, one would expect that the same physics apply in each shell layer, each scale, and, as a consequence, the distributions in each shell should be the same, up to a change of unit reflecting the different scale embodied by each layer. It turns out that the three curves for three different shells can indeed be nicely collapsed, but only for the small velocity fluctuations, while the large fluctuations are described by very different heavy tails. Alternatively, when one tries to collapse the curves in the region of the large velocity fluctuations, then the portions of the curves close to the origin are not collapsed at all and are very different. The remarkable conclusion is that the distributions of velocity increment seem to be composed of two regions, a region of normal scaling and a domain of extreme events. The theoretical analysis of LVO et further substantiate the fact that the largest fluctuations result from a different mechanism. Here is the message that comes out of this discussion: the concept of outliers and of extreme events does not rest on the requirement that the distribution should not be smooth. Noise and the very process of constructing the distribution will almost always smooth out the curves. What is found by LVO et is that the distribution is made of two different populations, the body and the tail, which have different physics, different scaling and different properties. This is a clear demonstration that this model of turbulence exhibits outliers in the sense that there is a well-defined population of very large and quite rare events that punctuate the dynamics and which cannot be seen as scale-up versions of the small fluctuations. 17. As a consequence, the fact that the distribution of small events might show up some curvature or continuous behavior does not tell anything against the outlier hypothesis. It is essential to keep this point in mind when looking at the evidence presented below for the drawdowns. Other groups have recently presented supporting evidence that crash and rally days significantly differ in their statistical properties from the typical market days. For instance, Lillo and Montaigne investigated the return distributions of an ensemble of stocks simultaneously traded in the New York Stock Exchange, NYSE, during market days of extreme crash or rally in the period from January 1987 to December 1998. Out of 200 distributions of returns, one for each of 200 trading days where the ensemble of returns is constructed over the whole set of stocks traded on the NYSE, anomalous large widths and fat tails are observed specifically on the day of the crash of October 19, 1987, as well as during a few other turbulent days. Lillo and Montaigne document another remarkable behavior associated with crashes and rallies, namely that the distortion of the distributions of returns are not only strong in the tails describing large moves but also in their center. Specifically, they show that the overall shape of the distributions is modified in crash and rally days. Closer to our claim that markets develop precursory signatures of bubbles of long time scales, Mansilla, 2001, has also shown, using a measure of relative complexity, that time sequences corresponding to critical periods before large market corrections or crashes have more novel informations with respect to the whole price time series than those sequences corresponding to periods where nothing happened. The conclusion is that, in the intervals where no financial turbulence is observed, that is, where the markets works fine, the informational contents of the binary-coded price-time series is small. In contrast, there seems to be significant information in the price-time series associated with bubbles. This finding is consistent with the appearance of a collective herding behavior modifying the texture of the price-time series compared to normal times. Implications for safety regulations of stock markets. The realization that large drawdowns and crashes in particular may result from a run of losses over several successive days is not without consequences for the regulation of stock markets. Following the market crash of October 1987, in an attempt to head off future one-day stock market tumbles of historic proportions, the Securities and Exchange Commission and the three major U.S. stock exchanges agreed to install so-called circuit breakers. Circuit breakers are designed to gradually inhibit trading during market declines, first curbing New York Stock Exchange program trades and eventually halting all U.S. equity, options, and futures activity. Similar circuit breakers are operating in the other world stock markets with different specific definitions. The argument is that the halt triggered by a circuit breaker will provide time for brokers and dealers to contact their clients when there are large price movements and to get new instructions or additional margin. They also limit credit risk and loss of financial confidence by providing a timeout to settle up and to ensure that everyone is solvent. This inactive period is of further use for investors to pause, evaluate, and inhibit panic. Finally, circuit breakers clarify the illusion of market liquidity by spelling out the economic fact of life that markets have limited capacity to absorb massive unbalanced volumes. They thus force large investors, such as pension portfolio managers and mutual funds, to take even more account of the impact of their size order, thus possibly cushioning large market movements. Others argue that a trading halt can increase risk by inducing trading in anticipation of a trading halt. Another disadvantage is that they prevent some traders from liquidating their positions, thus creating market distortion by preventing price discovery. For the October 1987 crash, countries that had stringent circuit breakers, such as France, Switzerland, and Israel, had also some of the largest cumulative losses. According to the evidence presented here that large drops are created by transient and rare dependent losses occurring over several days, we should be cautious in considering circuit breakers as reliable crash killers.